Good morning, everyone. Welcome to the Macro Snapshot. We are Friday, November the 21st, 2025. Okay, I want to first of all look at the data yesterday. We all know there was a large market sell-off in the equities, crypto space, but it is kind of interesting just to see whether maybe the data which was released, even though it's sort of old news in theory from September jobs report, whether that contributed. So let's have a quick look. And again, here we are on November the 21st. We're not getting October data at all, and November data will not be given to the Fed until after they meet. Although the question is, why can't they just push the meeting back a week? But anyway, I won't get into that. But what we did have yesterday was the September data. And as you can see, the non-farm payrolls, the actual number itself came in much higher than expected at 119,000. The seasonal adjustments were quite favorable, so the raw numbers probably not as positive as that. But basically, if you look at the numbers, they were pretty good in terms of the headline number. Although, as we say here, looking at the seasonality, it was actually a pretty favorable one. So who knows if the new head of the BLS is, I don't know, cooking the books a little bit. But what's interesting, if you actually look at where the jobs were created, so, okay, over 100,000 jobs, which on the surface looks quite positive. But a lot of the jobs were in the education and health services. We're talking a lot of people, sort of home help kind of people, government, and also in sort of leisure and hospitality is most of the creation. If you look at things like, for example, mining and logging, manufacturing, transportation and warehousing, professional and business service, a lot of these were either flat or negative. So I don't want to say, overread into this, but it is seeming so, sort of jobs, with home healthcare, maybe in the, leisure, hospitality industry, government jobs, they're being added to, but not so much in, more the manufacturing and other kind of jobs. So, is that a sort of a warning sign? The other thing as well is that if you look at, for example, US, as I say here, US private pay polls, excluding leisure, hospitality, education, healthcare, so those kind of, it's actually kind of negative. So the point is that it's not all rosy, even though that headline number was positive, and maybe that contributed to some market jitters. The other issue as well is that the unemployment rate up to 4.4. That's because the pool of available workers went up a little bit, and so therefore the unemployment rate went up, and possibly that will get the Fed's attention. So that's basically that. Just wanted to have a quick look at that. The other thing which is interesting is that the average hourly earnings actually went down. It was less than expected, 0.2 month over month. So that was lower than expected. So that's basically telling us that wage earners, workers apparently have less sort of bargaining power and cannot push for those higher wages, which we've been seeing over the last few years. That seems to be sort of flatlining a little bit, which is good for the inflation story, not so good for sort of wage growth with US workers. And therefore, that could be feeding into the consumption sort of worries, which we saw, let's say from Walmart and Target and some of these stores, basically saying that, although people are still spending, they're cutting back on luxuries and discretionary items and are spending more or focus more just on spending on essentials. The other thing which is interesting is that initial claims was pretty good, I have to say. Again, this is a choppy number. They tried to put together several weeks of data. But as you can see here in the blue, this is initial jobless claims. So people who literally initially, so for the first time, are claiming benefits. That actually is quite good. But if you look at the continuing claims here, which is, you can see that's actually pushing upwards. You see how the continuing claims, so that's people who for multiple weeks are continuing to claim unemployment benefits. You can see here that that's actually sort of pushing upwards. So could that be, leading to a situation where people are not being fired in massive numbers, but those who have lost their jobs, they're finding it increasingly difficult, taking longer to actually get new jobs. So a slightly, so just looking at all that data from yesterday, there are some positive numbers, but looking under the hood, as people like to say, there are some signs of weakness. So if we actually now just look and just see, we can see it's interesting to go through all the market reactions. So let's just have a look here and look at the VIX. First of all, you can see that volatility is actually at a pretty high level here. It got yesterday up to about 27 or so. So if we divide that by 16, we'll get this sort of, like a daily implied volatility move. And you can see here that we're up at, at least about 1.5%. So the fact that the VIX is up, we have expiries today, a lot of our options rolling off. So could it be that yesterday part of the move was, a lot of volatility in the volatility? And if we look at the VVIX, VIX, so the volatility to volatility, you could see like a huge spike up yesterday. So that may have got the market's attention just from a technical basis. And if we also look at something like the VIX futures here, you can see that they are pushing sort of higher as well in terms of the curve. So the front of the curve are definitely moving upwards. In fact, I'd prefer to look at that on another chart. But anyway, so volatility at an elevated level. And as I say, if we look at the VIX still today, at 25, so that's definitely, as you can see, at quite a high level. Although it's going to be interesting to see if that can push below, above that recent high. And if that comes down once we get through the expiries today, expiration on the Friday of the 21st, maybe volatility will come down, and that will be a headwind, sorry, a tailwind. That'll be a positive for the equities. So if we look at the equities, let's look at the futures. No surprises there. We all know the S&P was down, it was about 3% yesterday. Interesting because it initially got that pop. There was a bit of positivity after the Nvidia earnings, which were great and very positive. And then, as I say, the employment report and the initial jobless claims was, relatively solid. I mean, maybe not stellar if you looked into the details, but certainly wasn't a disaster. But possibly, as I was saying yesterday, the issue with Nvidia is that if Nvidia is receiving all the money from all of these other sort of so-called hyperscalers, the Metas and the Googles of the world and the Amazons of the world. The question is, maybe this is good for Nvidia, but it means that they're sucking capital expenditure from everyone else. And a lot of people are just increasingly, I want to say people, I mean like analysts, the street, um, all the big banks are starting to really look into these numbers and saying, is AI the return on capital expenditure? Is it going to justify this massive sort of outlay? And secondly, the free cash, like the balance sheets of these very successful companies, the Mag Sevens, are sort of starting to sort of dwindle a little bit as they need to sort of spend money on capital expenditure for AI build-outs. And secondly, as they start to borrow a lot more money. So we're starting to see some pressures in the credit market as well. Anyway, here we are. Just from a technical perspective here, you can see we're at a pretty interesting level here. A lot of support. This is a strong level, the 100-day EMA. This is quite critical. If, once we get through options expiries today, which, as I say, should lead to a diminution of volatility, that in theory could be a positive for the equities. So it'd be interesting to see if we get some sort of, late or mid-afternoon rebound here, because if we can't hold here, obviously from a technical perspective, just looking at the chart here, the next level down does seem to be, first of all, maybe the 200-day EMA, 63.90 on the ES futures, and possibly even down to this level here, which is about the 63.15. Now, if we start looking at a couple of fib levels here, we can look at a few sort of Fibonacci's here, just because we like to do that. Let me just move some things onto the charts here, guys. So if we look at a couple of fibs here, I mean, if we do this shorter term one, so this impulse here from the 4th of August, you can see it's also a critical level. You see here we're right at the 61.8 fib retracement. And if you have the pocket, the 65 as well, it's kind of a nice pocket between the 61.8 and the 65. So that this is right there now at the 65%, which is just above the 61.8, the classical one here. So this is a key bounce area. No surprises, this is going to bounce up. But what I would also say is that, if we just put this back to, I mean, it's maybe something like back here or even sort of here. You can see that the next levels are definitely down here as well. But what is interesting as well, if we break this down to a 4-hour chart, so of course, we had the big breakdown yesterday, this big sort of engulfing red candle here. You can see the market here at this fib level, at this sort of support at the 100-day EMA. So pretty critical here that the bulls hold it. But what I would suggest is that even if the bulls bounce, it could just be a reactive bounce and technical bounce off levels. So what we really also need to see, and I'm just going to put it here, is in order for this to become in any shape or form sort of bullish, this will then have to start clearing some of these other fib levels. So anything before, let's say, the 38% fib retracement is simply a reactive bounce. Okay, so let's not get too excited, even if this goes up, for 65.50 up to, 66.50 or something like that, 100, 125 points would be absolutely normal. And keep in mind with the VIX at 25, a daily intraday moves of, 150, 175 basis points is absolutely mathematically sort of on to be expected, so to speak. that would actually just be the normal range. So the point is here, let's not get too excited if it bounces. This is an attractive entry level if you can get in at like, 65.20, 65.30 with a very tight stop loss, because for sure there's a lot of technical support here. As I say, 100-day moving average, you've got the fib levels, and you also have horizontal level of support. So let's have a look and see. But really, for the bulls to be back in charge, they really need to start getting through some of these fib zones. As I say, 66.90, even above the 50% fib retracement, 67.40, something like that. We shall see if they get there. Okay, so let's just get back to some of the charts. Similar situation, not only with the Nasdaq. Nasdaq actually fell worse. You see here, that's actually a bit heavier. And really, the Russell was the big underperformer here. You see, the Russell has not only blown through the horizontal supports and the 100-day moving average at about 23.90 or so, it's actually gone all the way down to the 200-day moving average. So really, really underperforming the other indices here. And if the Russell can't hold it here, boy, you've got to say that this could be heading down to, I'd say this level here, 2180, 2200 is the next sort of clear target on the downside. Just no surprise here that the Mag 7, big engulfing candle here on the Magnificent Seven ETFs. Again, pretty critical level, but there is technically more downside. Quite a lot of technical damage has been done here. This is, we see here some of these moving averages starting to roll over. If we see the equal weights also down to the 200, that's similar to the Russell. So the equal weights also not doing particularly well. And just in terms of breadth, no surprise here that the breadth had been rolling over and just took yet another sort of punch in the stomach, so to speak, yesterday. And this is basically signaling the percentage. Only now 30% of companies which are trading above the 50-day moving average here. So you can see that the breadth is narrowing as well. So we've got the top companies, the big Mag 7s under pressure, and also the small caps under pressure. So basically everything under pressure. And this is just not a US story. If we just have a look at a few other indices, you can see over in Europe, also taking a tumble yesterday, but again, finding a little bit of support. You can see that the Nikkei also down. The Indian, actually, the Indian one is interesting because the Indian one is almost the Sensex, the only global index which didn't really fall much. I mean, if you look at something like the Aussie, much higher correlation with the US, that's also down. So globally, most of the indices down. We look over in, let's say, Korea, the Kospi, which had been on a tear, the momentum had been rolling over, and the Kospi now, down into some of these fib levels as well. So global equities down. We can also look at emerging markets in general, big red candle yesterday. So equities down. So, what did well? I mean, basically, interesting that the bonds initially sold off after the employment data. But as we can see here, actually, we'll just look at the Fed thing, because if you look at the 2-year here, which is probably the closest of those bonds related to the Fed, you see even today still going up a little bit, but pushing up strongly yesterday. If we actually just look at the Fed Watch tool, it's pretty crazy change, because just with that sort of weakness in the equities market and the unemployment rate going up and the average hourly earnings going down, signaling less inflationary pressures potentially, even though the headline number was good. Suddenly here we are, the 65% chance essentially of 2/3% chance of a cut suddenly now in December. And look at that compared to yesterday. You can see that yesterday we were down here, if you remember, all the way down here, and suddenly it's pushed up to 60 this percentage as well. So basically bouncing around on data, and we do have more data coming in next week. I think we have the JOLTS numbers, if I'm not mistaken. I have to double check that, but we have some new data coming in, so that's going to push around. What's also interesting here is just looking at the other bonds. You see here the ZN and even the long-term bonds here, the ZB getting a push as well, just on fears of maybe overspending by some of these hyperscalers and just the general economy rolling over. So the bonds, reacting relatively well yesterday as a traditional sort of anti-correlation, as a buffer against the equity weakness. If we look here at, you can look at the high quality, the investment grade bonds. Not underperforming too much here. And if you look at that compared to junk, you see junk down a lot more. So basically, junk underperforming and a high yield underperforming investment grade quality, which is kind of to be expected. Although do note the investment grade quality also did fall a little bit. And again, maybe concerns that companies like Oracle and Meta are really starting to borrow enormously and doing a bit of damage to their balance sheets. Just having another quick look over some of the markets, you can see here that oil, I signaled yesterday that oil was sort of just grinding sideways. It did fall yesterday and it has been falling in the overnight session, although having a little bit of a bounce now. No surprises there. When you have global sort of equities falling and sentiment very much a risk off, oil is going to fall down there. There wasn't a huge reaction in the currencies. I'll get back to the currency because I want to speak about Japan in a second. Not a huge reaction in the currencies, but so we saw that oil falling. And if we actually look here at the metals, interesting to see that gold it actually didn't do too badly. It didn't really perform as well as one would have hoped in that sort of scenario. So gold sort of fiddling around yesterday, just sort of a bit of a choppy sort of range. And maybe that's just because gold. One of the reasons it's been going up is really a concern about sort of overspending, a strong economy, inflation, and one could argue that yesterday was the was not that, was the opposite of that. So gold not really ripping higher and not really being deleveraged and selling off massively. What is interesting and kind of predictable is that silver underperformed gold. You see here that silver, had a bit of quite, sort of a sell-off yesterday, which is to be expected because it has a higher beta to kind of global sentiment. What is interesting for me is copper. That copper did sell off yesterday, but didn't have any kind of sort of crazy collapse. I mean, look at copper. This could be a very volatile product. And all things considered, I think that copper actually reacted quite well in sort of a global de-risking sort of scenario yesterday. And you can see even this morning, copper finding, a little bit of a bid, not to say that this is suddenly going to rip higher, but just interesting to watch. And that indicates to me that copper, sort of structurally, there's a little bit of support for that because that, and I'm surprised not to see copper, maybe down at like, 4.75 down here or something like that. It's actually reacting quite well. Not the case for Bitcoin. We all know in the crypto space that Bitcoin's been under a bit of pressure. And just sort of technically here, it could be coming up to a little bit of support because we have it's obviously broken this sort of uptrend level here. But if you go back to, let's say, the 7th of August and look at this nice sort of up impulse, if you look now at the Fibonacci here, we're now at the 61.8, which is coming in, around where we also have, some recent lows from the March lows at about, let's call it about 79, 80,000, something like that. So Bitcoin is starting to get into sort of areas where it may actually see a little bit of dip buying here and support, because for sure, for people who believe in Bitcoin and think it's a good long-term hold, it's come down now 37%. So this is for sure there's a nice discount, so to speak, from its highs, which we saw back at the beginning of October, about 125,000. And as I say, this is coming into quite an interesting support level. If it can't hold here, then obviously, the next level down is maybe in the 70s and 60s, but we're not quite there yet. Let's just see how that goes. As I say, I just wanted to get back to Japan. Let's just look here because we had global yields going down on most of the bonds. So just want to check in and see the situation in Japan because let me have a look. Yeah, so that's also the case in Japan that yields came down a little bit. And we also, on this, as on the 30-year, and we also saw the Japanese yen having a slight bid against the US dollar. You can see here that the US dollar peaked out yesterday. US dollar overall was quite strong yesterday, but the US dollar down a little bit against the Japanese yen. And this is going to be fascinating to watch because we saw yesterday as well is that the new Japanese government under Prime Minister Takeichi, they are introducing the stimulus package. If you put it all together, so the new stimulus spending of, I think, over 20 trillion yen, plus what had already been earmarked for the budget of spending. So we're talking about a 45 trillion yen sort of injection of stimulus, and new spending is going to be, I think the number I saw was about 125 billion US dollars. And basically the Prime Minister saying that that would be funded by new bond issuance. So keep in mind that the long end of the Japanese curve is under a lot of pressure. Those yields are going up with all this issuance. We saw overnight a CPI across Japan was over 3%. Now that was kind of expected, but the point is that Japan is no longer in this deflationary, 0% inflation situation. It definitely has in the low twos, early 3% of inflation. And so there's a real tension developing now whether, the BOJ will hike interest rates just to try and, tampen down inflation and to normalize and to keep inflation under control. On the other hand, you have the government, essentially issuing new stimulus and basically saying that's going to be funded by new bond issuance. Although On the other hand, the BOJ, which has been a massive, massive, massive buyer of bonds over the last couple of decades, and they're actually reducing the amount of bonds they're buying. And so there's a real tension here because the BOJ continues to buy less bonds, the government is issuing, or the Treasury, the Ministry of Finance is issuing more bonds. We could continue to see upward pressure on the Japanese yield. So it's going to be a fascinating dynamic here. And we see here that the US dollar did weaken a little bit against the Japanese yen. But I think overall the trend is quite possibly going to be for slightly higher yields because the only safety release here, if the yields are going to be capped effectively, their yields are going to be the yield. There's going to be a yield curve control essentially by the Bank of Japan if they continue to buy. The safety valve, the release mechanism has to come through the currency, and that's why we've seen the Japanese yen under a lot of pressure. Now, why did it go down yesterday? Also, because there was a lot of verbal intervention. We're starting to get some quite aggressive verbal intervention. We had the Ministry of Finance, I think it's Katayama, Madame Katayama, essentially saying that she was watching with, heightened urgency. They have a whole hierarchy of terminology, heightened urgency about the unjustified moves in the Japanese yen. I would argue, well, what I just have been arguing is that these moves actually are justified. So I'm going to be curious to see here whether this lasts and whether the market starts to push up a little bit. Although, as I say, we are getting close to these levels, which we've been looking at for a few days now, maybe up towards the 158, 159. I think the market probably wants to test up there, but for sure there is the possibility, potentially increasing of not only verbal intervention but real intervention by selling US dollars. Who knows? Maybe we even saw a little bit of that in this session here. We will see. But as I said, the structural elements for me are for the Japanese yen to weaken further, maybe not massively further, but certainly to maybe test up towards these 159, 160 levels in theory, as long as the Japanese government there continues to issue even more debt, which is being subsidized or sort of eaten up, absorbed by the Bank of Japan purchases. We shall see how that falls out. Okay, guys, I'll leave it there. Have a great trading day. It's going to be interesting today to see whether people come in and buy that level on the equities or whether they let it bleed down a little bit through those levels. Let's keep an eye on that. Have a great weekend, and we'll be back next week with more of this. Thank you. Goodbye.